4 things just happened in the last 72 hours that tell you exactly where silver is going next. And one of them is something the United States government has never done before in the entire history of this country. Silver is trading at $77.44 per ounce, up 5.73% in a single session. Gold just broke back above $5,000. And if you understand what I am about to show you, you will realize why this recovery is not random. It is structural. It is policy-driven. And it is about to get much bigger. Now, let me show you the 4 pieces, because when you put them together, they tell you everything. First, the United States government just confirmed a critical minerals price floor system, and silver is included. Second, Hecla Mining, the largest silver producer in North America, just reported fourth quarter earnings. And buried in those numbers is proof that industrial buyers are bypassing COMEX entirely and paying massive premiums to buy silver directly from the mines. Third, APMEX, the largest online precious metals dealer in America, just told customers that shipping is finally back to normal after a full month of chaos. But the letter they published tells you the physical silver market completely broke in January. And fourth, there are currently 35,000 call options on March COMEX silver futures sitting in the money right now, even after a 46% crash. The banks could not knock them out. When I saw all 4 of these hit within 72 hours of each other, I knew this was the signal. Stay with me, because by the end of this video, you will understand why the paper silver market is dying in real time. Let me start with the biggest story, because this one changes the game permanently. On February 4th, 2026, Vice President J.D. Vance stood in front of representatives from 55 countries at the State Department for the Critical Minerals Ministerial, and he said something that should have been front-page news everywhere. He said the United States will establish reference prices for critical minerals at every stage of production. And for members of the preferential zone, these reference prices will operate as a floor maintained through adjustable tariffs to uphold pricing integrity. Let me translate that for you. The U.S. government is telling the world that critical minerals, which include silver, will have a minimum price, a floor, below which the price cannot fall within the trading block. And they are backing it with tariffs to enforce it. This is not a suggestion. This is policy. The European Union agreed. Japan agreed. Mexico agreed. 11 countries signed bilateral agreements on the same day. On Monday, February 3rd, Trump announced Project Vault, a $12 billion critical mineral stockpile, $10 billion from the U.S. Export-Import Bank, $2 billion in private funds. The stated purpose is to stabilize prices and support manufacturers. Now, here's what nobody in the mainstream media is explaining. A price floor means the U.S. government is admitting the free market price of critical minerals is broken, that China's dominance in refining and processing has distorted prices to the point where Western companies cannot compete. And the solution is not to let the market work. The solution is to set a price floor. This is the most bullish policy development for silver I have seen in my lifetime. Because if silver has a government-backed price floor, every ounce you hold has a backstop. The government is telling you your silver will never fall below a certain level within this trading block. Think about what that means for miners, for industrial buyers, for anyone holding physical metal. And here is the timing that should tell you everything. This announcement came out when silver was trading at $74, down from $121 after the biggest crash in 46 years. The U.S. government looked at silver at $74 and said, the market price is broken. It is too low. We need to put a floor under it. Read that again. The government of the United States is telling you the current price of silver is artificially suppressed. Now let me connect this to what I showed you in previous videos. China's silver export controls, 44 companies licensed. Silver reclassified as a strategic material. What Vance is doing with the price floor is the Western response. China is restricting supply. The U.S. is guaranteeing price. Both actions point in the same direction. Silver is going higher. The only question is how much higher. And let me remove all doubt about whether silver is actually included in this. On November 7th, 2025, the U.S. Geological Survey finalized the 2025 critical minerals list. They added 10 new minerals. For the first time in modern American history, silver was included. Silver now sits alongside lithium, cobalt, uranium, rare earth elements, materials deemed essential to U.S. economic and national security. And on February 17th, Under Secretary of State for Economic Affairs, Jacob Hellberg confirmed that multiple U.S. agencies have developed the price floor system and are now pitching it to allies worldwide. Bloomberg reported it yesterday. This is not rumor. This is confirmed policy. The infrastructure is built. The funding is allocated. The legal framework exists. What does not exist yet is the actual silver in the stockpile, because, as of today, the U.S. government holds virtually zero strategic silver reserves. The last strategic silver reserves were sold off through the 1990s. That means the US government is about to become a brand new buyer in the global silver market. A buyer with a $12 billion budget, a congressional mandate, a national security justification, and literally zero existing inventory to start from. Now let me show you what Hecla Mining just revealed, because this is the proof from the supply side. Hecla Mining Company released their fourth quarter and full year 2025 results on February 17th, yesterday. Revenue $1.4 billion, up 53% from last year. Net income $321 million. That is 9 times more than 2024. 9 times in 1 year. These are the best numbers in Hecla's entire 135-year history. But those are not the numbers that matter most. This is the average market silver price for the fourth quarter of 2025 was $54.83. That is what COMEX said silver was worth. Hecla's average realized silver price in the fourth quarter was $69.28. Let me make sure you caught that. The market said silver was $54.83. Hecla got $69.28. That is a $14.45 premium, nearly 26% above the average market price. Not in Shanghai, not in some back alley deal, in America, from America's largest silver miner, reported to the SEC on the record. That is not a rumor. That is an audited financial statement. Now, how does a mining company realize a price that is 26% higher than the market average? There are only 2 explanations. Either Hecla held back production and sold everything in late December when prices spiked higher, which would mean they were timing the market rather than selling steadily. Possible, but unusual for a company of this size. Or industrial silver buyers are going directly to silver mines and paying a premium to secure physical supply, bypassing COMEX entirely, because they need actual metal for manufacturing and they cannot rely on the exchange to deliver it. I think it is the second explanation. And here is why. We already know Samsung locked up 100% of the output from the La Pria silver mine for 2 years through a direct prepayment deal. We already know London lease rates hit 34.9% in October because institutions were desperate to borrow physical silver. We already know Shanghai physical silver trades at a 20% to 30% premium over paper. And now we have the largest silver miner in North America reporting a 26% premium on their realized price. This is not a coincidence. This is a pattern. Industrial buyers are going around COMEX. They are going directly to the source because the exchange cannot guarantee delivery. And when buyers are willing to pay that kind of premium to get silver directly from mines, that tells you the real price of silver is not what COMEX says it is. The real price is what someone will actually pay to get their hands on it. And right now, that price is far higher than the ticker on your screen. Now here's the detail that tells you where Hecla thinks silver is going. They are selling their gold mine for almost $600 million to go all in on silver. Gold is at $5,000, and they are selling the gold mine. Let me say that again. They are choosing silver over gold at $5,000 gold. These people know something. Their 2026 guidance calls for 15 to 16.5 million ounces of silver production, and they are nearly doubling exploration spending to $55 million. And their cost structure tells you why they are this confident. All-in sustaining cost, $18.11 per ounce. Realized price, $69.28. That is a $51 margin on every single ounce, 74% margin. Their Greens Creek mine in Alaska reported a negative cash cost after byproduct credits. Negative. They are getting paid to mine silver. That is how profitable this is at current prices. Now let me show you what the CEO of APMEX just told his customers, because this one is personal for anyone who buys physical silver. Ken Lewis, the CEO of APMEX, has been publishing letters to customers throughout January and early February. On January 14th, he instituted a $10,000 minimum order. APMEX was 4 days behind on shipping. Customer service headcount increased by 25%. They reduced their product selection to 31 core silver products and could only keep 21 of them in stock. On January 18th, the minimum dropped to $500, but he said their mint output was impacted by approximately 50%. Pre-sale dates extended 3 to 5 days longer, and he thanked customers for their patience during what he called historical volume. Saturday, January 17th was the third busiest Saturday in APMEX's history, 4 times a normal Saturday. Let me put this in context. APMEX is the largest online precious metals dealer in the United States. And for roughly a month, they could not ship silver on time. They instituted order minimums to throttle demand. They increased customer service staff by 25%. They limited product selection. And the CEO published multiple letters apologizing for delays and thanking customers for patience. This is the largest dealer in the country, with decades of experience, with massive warehouses and minting operations, and they were overwhelmed for an entire month. If that does not tell you the physical silver market is broken, I do not know what will. Now, here's my question. If APMEX is back to normal now, Is it because supply caught up with demand? Or is it because the 46% price crash scared enough buyers out of the market that demand temporarily dropped? I think it is the second one. And here is why. The crash happened on January 30th. APMEX says they are back to normal by mid-February. That is 18 days. 18 days for APMEX to clear their backlog after the crash temporarily reduced buying pressure. So what happens when silver starts running again? When prices recover? When the next wave of buying hits? If it took APMEX a full month to catch up after a crash killed demand, what happens when demand comes back? The answer is the same thing that happened before. Delays, shortages, premiums, and the cycle starts all over again. And I want to be clear about something. The fact that APMEX had to write these letters at all is the story. The CEO does not publish multiple letters saying, please be patient. We cannot ship your silver during normal times. These letters exist because the physical silver market broke for a full month. And they are telling you it is fixed now. But the structural shortage that caused it has not changed. The deficit is still running, the inventory is still draining, and the demand is still growing. I also want you to notice what he called this period historical volume, unprecedented demand. The CEO of the largest precious metals dealer in America, a man who has seen every market cycle for decades, he's calling this the most extraordinary period he has ever seen. That is not the language of someone who thinks it is over. That is the language of someone who knows what is coming next and is getting his operations ready for round two. Now the fourth piece, and this is the one that connects everything to March 27th. There are currently approximately 35,000 call options on March 2026 COMEX silver futures that are in the money. These are options that give the holder the right to buy silver futures at prices below where silver is currently trading. They are profitable right now, even after a 46% crash. Traditionally, the bullion banks try to slam the silver price before options expiration to prevent as many calls from expiring in the money as possible. We saw this on January 30th. They crashed silver from $121 to $64 in a single session. That was the slam. That was the attempt to knock every call option out of the money, and it did not work. Even after a 46% crash, 35,000 calls are still in the money. The banks lost control of the silver price to such an extent in January that even the most violent crash in 46 years could not kill enough of these options. Silver has recovered from $64 to $77.44. And every dollar it recovers, more calls come back into the money. Now here is the question that should keep every bullion bank awake at night. What happens if a significant portion of these in-the-money call option holders exercise their calls? If they exercise, they receive a long March silver futures contract. And if they then stand for delivery on that contract, they are demanding physical silver from COMEX. The same COMEX that has 82 million ounces of registered silver against over 400 million in open interest. This is the scenario I have been warning about. The crash was supposed to wipe out the calls. It did not. The crash was supposed to reduce delivery demand. It did not. February deliveries are running at 98%. And now 35,000 calls are sitting in the money with less than 40 days until March 1st notice day. Let me put a number on this so you understand the scale. Each COMEX silver futures contract represents 5,000 ounces. 35,000 call options, if exercised, would represent 175 million ounces of potential delivery demand. The vault has 82 million ounces registered. Even if only a fraction of these calls are exercised and stand for delivery, the math does not work. The vault does not have enough metal. Now, will all 35,000 exercise? No. Most options traders close for cash. They do not want the metal. But here is what is different this time. We are in an environment where industrial buyers need physical silver, where Samsung is locking up entire mines, where Hecla is getting 26% premiums from direct buyers, where Shanghai physical silver is 20% above paper. In this environment, the incentive to exercise and take delivery is higher than at any point in modern history. Because if you can get COMEX silver at $77 through an exercise call and sell it to an industrial buyer at $95, you are printing money. The arbitrage is real, and smart money knows it. Now let me connect all four of these stories for you, because separately they are interesting. Together they tell you everything. The price floor is the government admitting the market is broken. Hecla's numbers prove it is broken from the supply side. Miners are getting 26% more than the paper price. APMEX proves it is broken from the demand side. The largest dealer in America could not ship for a month. And 35,000 in-the-money calls are about to test whether it can survive being broken from the delivery side. 4 different angles. Same conclusion. The paper silver market is dying, and the physical market is replacing it in real time. Now let me tell you what I think this means for prices. Gold is recovering to $5,000. It touched $4,865 earlier this week and bounced hard. The recovery is happening because the market is digesting the price floor news. When the US government tells 55 countries that critical mineral prices need a floor, capital starts flowing back into the metals that were just crashed. Silver is back to $77.44. It bottomed at $64 on January 30th. In less than 3 weeks, it has recovered 21%. And I want to point out something important about the recovery pattern. Silver crashed 47% in one day and has been grinding higher almost every day since. That is not the behavior of a bubble that popped. That is the behavior of a market that was artificially crashed and is now reverting to its real price. Bubbles do not recover in straight lines. Engineered crashes do. And here is what is driving the recovery beyond just the price floor news. The fundamentals have not changed. The 6-year supply deficit is still running. COMEX inventory is still at 82 million ounces. Shanghai premiums are still 20% to 30%. The delivery rate in February is still 98%. China is still restricting exports. Nothing that caused the crash addressed any of these structural problems. The crash was a band-aid on a broken bone, and the bone is still broken. The price floor changes the game. It tells miners to invest. It tells industrial buyers to secure supply. It tells investors that the government has their back. And it tells the shorts that the floor is being built under your feet while you are standing on the wrong side of the trade. I have been covering this market daily, and I can tell you the sentiment has shifted. Before the price floor announcement, the narrative was silver crashed, therefore the rally is over. After the price floor announcement, the narrative is becoming the US government just confirmed that silver is underpriced. Those are two completely different stories. And the second one is the one that moves capital. So the next time someone tells you the silver rally is over, ask them one question. If it is over, why is the US government building a price floor for it? I would love to hear their answer. And here is the piece that ties it all together with my previous videos. In my COMEX video, I showed you 785,000 ounces draining every single day. March delivery needs 107 million. COMEX will have 85 million. Now we know part of what is coming. A US-backed price floor for critical minerals. Hecla confirming that the real price of silver is far above the paper price, and 35,000 in-the-money calls approaching first notice day. Remember what I showed you about the January 30th crash. JP Morgan accepted delivery of 633 contracts at the exact market bottom. Perfect timing, every single time. While the media was telling you buying silver makes you anti-American, the US government was building a price floor for the exact metal that narrative was trying to make you feel ashamed for buying. The government is betting on silver with 55 countries at the table. You cannot make this up. When the most informed people in the silver industry, the people who literally pull it out of the ground, are making the biggest bet of their corporate lives on silver going higher, what does that tell you? So here's my assessment. The US price floor is the most bullish policy development for silver in my lifetime. Hecla's 26% premium proves the physical market has already separated from the paper market. APMEX's month-long shipping crisis proves physical demand overwhelmed the entire dealer infrastructure. And 35,000 in-the-money calls prove the January crash failed to achieve its objective. Gold at $5,000, silver at $77.44, less than 40 days until March 1st notice day, Chinese markets reopening on February 24th, a US-backed price floor in development, industrial buyers paying premiums directly to mines, and the largest silver producer in history just had the best year in its 135-year existence. This is my opinion, not financial advice. Do your own research. Make your own decisions. But every piece of data, every government action, every corporate filing, every market signal is pointing in the same direction. The price of silver in COMEX is not the real price of silver. The real price is what Hecla gets from industrial buyers. The real price is what Shanghai charges for physical. The real price is what the US government is about to set as a floor. And all of those prices are much higher than what your screen says right now. You can print contracts, you can crash prices, you can write letters saying shipping is back to normal, but you cannot print silver. You cannot manufacture 135 years of mining expertise overnight, and you cannot unconfirm a US government price floor once it has been announced to 55 countries. The floor is being built, and silver is standing on it. Drop a comment and tell me what you think the US price floor means for silver prices. I want to hear your number. Where does silver go by the end of 2026 with a government-backed floor? Share this video with one person who does not know about the price floor yet. Most people have no idea the US government just told 55 countries that critical mineral prices are too low. That single fact changes everything. If you are not subscribed, hit that button now.